back to the latest and greatest Unqualified Opinions. I'm 2-Bit Idiot, Ryan Selkis, here to talk today about all things stablecoins with Edan Yago, who's the founder of CementDAO. And really excited for this conversation. I think there's quite a bit of potential for stablecoins in general. They bring a ton of liquidity to the crypto markets. Historically, they've driven quite a bit of growth, regardless of what you think of Tether. It was probably one of the most profound innovations and most important innovations for the crypto markets, particularly given some of the regulatory uncertainty over the last few years. And now we've got a wide variety of options beyond just USDT and Tether. Edan, would love to dig into why exactly you're trying to create basically a stablecoin of stablecoins, and why it's so important to create better interoperability between these assets. So before we dig in, why don't you quickly introduce yourself, and obviously you and I have known each other for years. You've been around the block in crypto. Tell us a little bit more about your background, how you got to work on CementDAO, and why you're all in on stablecoin infrastructure these days.
Thanks very much, Ryan. Great to have another chance to chat with you. So yeah, like you say, I've been in crypto for a while. My background is in neuroscience, and I up until 2011 was involved in entrepreneurship on the biotech side. I was involved in 2 biotech companies, and in 2011. Because the work I was doing was working with neural networks and trying to use machine learning to identify better ways of identifying different diseases using machine learning diagnostics, I was reading a lot of papers in the networking space. And so randomly I came across the Satoshi white paper, and I was hooked immediately. But even before I'd fully digested the white paper, I was sending out emails to all of my friends, which were promptly ignored, that they have to get into Bitcoin. This is going to be the biggest thing and then I slowly got into it. And that wasn't my experience at all. And I think the reason is I was primed for cryptocurrencies from a young age. So I come from a family of refugees who only survived through their wits and through the fact that they managed to stash away some hard currency or jewels. I grew up in South Africa. My family were very politically active there, and the apartheid government declared some of them to be terrorists. And so I ended up between the ages of 9 and 11 smuggling gold out of South Africa to get money to my family. And so many, many years later, when I came across Bitcoin, to me, the utility was obvious. And ever since, I've been involved in trying to get cryptocurrencies into the hands of as many people as possible. I'm fascinated by one thing in particular, which is the payment side of cryptocurrency, because I think that that's the way that we get people to have mainstream users to get cryptocurrencies. And so I've been involved in a number of projects over the years around that, and that's what's ultimately brought me to stablecoins. I feel like stablecoins are the most likely way that the majority of people are going to interact with cryptocurrencies and blockchain. It's the most likely way that people are going to have access to uncensorable money, and it's most likely because people want something which is familiar and which is easy to understand. For mainstream adoption, you need to massively reduce the barriers to entry and the frictions around being able to use something. And there's nothing less frictionful than just doing what you've always done, using dollars, using euros, using yen.
Can you walk through kind of the history of stablecoins and the different economic models? So, it's one thing to say that you're going to create a decentralized dollar reserved or kind of fixed price cryptocurrency. It's quite another to pull that off, because if it is dollar reserved or some fiat currency reserved, then that means that you have those reserves on hand somewhere, right? And so it's touching the legacy financial system in some way. If you're trying to do it algorithmically or strictly via code, you introduce black swan risks if you get any of your security assumptions off. If you're thinking about creating a synthetic basket or thinking about like a seigniorage shares model where you're offloading risk on one set of users that are going to absorb that risk in behalf of the other users in order to make a return, that presents probably a third type of stablecoin project and a way of thinking about the trade-offs between decentralization, security, and making sure that these systems function. So where does CementDAO sit, and can you kind of walk through what you view works and what doesn't, and what some of the trade-offs are that some of these different projects are making, yours included?
Yeah, so how to create something which is dollar denominated or euro denominated or denominated in any way to something which is off chain is a very difficult problem. And like you say, whatever method you choose, you're going to be generating some degree of risk of losing the peg, a risk of centralization, risk of regulatory involvement, which removes the uncensorable aspect of what you're trying to do, or all of the above. And so when you're using a token which isn't the native token of a chain, you're dealing in a world of compromises. You're dealing in a world of imperfect. And then the question becomes, all right, so how do you manage those risks? And beyond the risks, how do you manage the fragmentation that comes with a world where you can have multiple different tokens, which are all being created and all being issued, trying to represent the same thing? So what we're doing with CementDAO is we're tackling those two problems. Right now, we are seeing a huge number of different types of assets being tokenized on various different blockchains, right? So the most obvious is the US dollar, and all of the big stable coins, all of the biggest stable coins are US dollar. But in addition to that, there's euro, there's other currencies. And in addition to them, there's gold and silver and petroleum, and even less, commoditized things like IBM shares or the shares of different companies, public or not, and even derivatives. And so for each of these different things, you have multiple different issuers, and each of these different issuances have their own risks. So with CementDAO, what we're building is a platform which is designed to work across chains, allow all of these different representations to be standardized. In other words, you have multiple different issuers, but they're all interoperable for the other. So if we have DX Exchange and eToro X Exchange and a broker in India and a broker in Hong Kong and a broker in the United States, and for various regulatory reasons or competitive reasons, they're all issuing tokenized versions of Tesla shares. You actually don't want there to be 6, 7, 20 different tokens of Tesla shares, which all trade against each other and fluctuate, and it's not clear which one is the Tesla share. What you want there to be one layer, which is the Tesla share. And what CementDAO does is it provides a protocol which combines these different issuances, allows there to be decentralization by having multiple different issuers, but at the same time makes them fungible for each other, these different tokens, and also protects the holders, or allows the holders to be protected from the risk of one of the holders going defaulting effectively on the issuance that they've created. So
go ahead.
Please, yeah.
Finish the thought.
Yeah.
But doesn't that suggest, though, that you're always going to have some slippage in value, right? So if you're basically creating an interoperable exchange of stable coins, and there's any mispricing from the underlying stable coins that are components of this index, then the user is essentially paying something akin to an interchange fee that they would using traditional payment technologies, right? Because there's a 50 basis point spread between two CementDAO components. You guys might be able to make that market and allow for interoperability, but it's not necessarily saving fees relative to the legacy system. Is that even a goal at this point, or do you just view stablecoins as something that people are going to use, and so a fee that's in the 25 to 100 basis point range is going to be something that people accept in the near to medium term?
Right. So that's an excellent question, and I think you're right to put your finger on the word interchange. And I think an analogy here is worthwhile because while what we're doing in crypto is extremely innovative, it's not like similar things haven't happened before. So there was a new network technology that was invented, which led to tokenization of money. And that new network technology was invented in the 1950s, or actually even before, but started to become popular in the 40s and the 50s, and it was called the telephone. And as different stores and banks started to get hooked up to the telephone, somebody came up with this idea of tokenizing money and creating stable coins. The way they tokenized it was in the form of plastic or metal cards, which they called bank cards or credit cards. And so you had Wells Fargo cards and Wells Fargo currency that was attached to those cards, and Bank of America cards and the Bank of America stable coin that was attached to those cards. And if you were a user and you were a customer of Wells Fargo, you could get the Wells Fargo credit card. You could spend the Wells Fargo tokenized currency, but only at merchants that accepted the Wells Fargo currency. And this was a mess. And in fact, everyone became dissatisfied with it over the course of the next 10 years until what they created was the world's first interchange in the way that I think you're describing it, which eventually got turned into its own company and became Visa. And what that allowed is if you had a Wells Fargo card, you could go spend it at any merchant, and that merchant didn't need to be a customer of Wells Fargo. They could be a customer of any one of the different banks. Today we have a similar situation, right? So every one of the major exchanges are now issuing their own stablecoin. Their customers can get an on-ramp into this tokenized fiat through their exchange. And if you're a customer of Coinbase, you can get USDC. But if you want to spend it, or trade it on a different exchange, then that exchange either has to list that token, and so they're listing more and more tokens, or you need to do the work yourself of swapping it for whatever the native stablecoin of that exchange is. And so what CementDAO first and foremost does is it provides that type of interchange. It allows USDC to be sent to an address which wants USDT and to be in the very act of being transacted as an atomic transaction, be converted into USDT. And neither of the participants even need to know that this happened. They're just transacting dollars. So there is an interchange fee that needs to be assessed for that because there are differences in the prices. Mm-hmm. Now, what's cool about the differences in the prices is these differences in the prices exist even today with the banks. So the reason Visa, among other things, has an interchange fee is because actually there's risk associated with Bank of America dollars or Wells Fargo dollars. They're not fungible at the level of the bank. So when Wells Fargo look at Bank of America dollars, they don't think of them as fungible for their own. And so they assess a fee for taking on the risk of having to handle the credit of another bank. Mm-hmm. But to the consumer, this is invisible. What crypto does, and what I love about crypto, is it makes it explicit. So right now, and that's the advantage of a peer-to-peer decentralized system. So what our system does is basically allow people to transact dollar value. Anywhere the dollar value is accepted, or euro value, anywhere the euro value is accepted, then there is a small fee associated with that. And what we think is going to happen is that over time, people are going to start to think of stablecoins not as a particular brand, but as the brand that they're all aspiring to be, which is the dollar, the euro, the yen, or the gold. And that transaction fee, that interchange fee, will just become part of the general fee of transacting, in the same way that you pay a small amount of gas when you transact an ERC20 token or an ERC20 stablecoin. And the actual fees associated are very, very low. Our system is designed just to maintain the amount of fee that is required in order to balance out the different fluctuations in risk.
Mm-hmm. So walk me through the implementation of something like CementDAO. So merchants on one hand accept USDT. Some of the international exchanges have Tether pretty strongly integrated into their systems. If you were to support USDT then at the merchant level, where previously they're just using USDC, or you wanted to support USDC as someone tried to actually send funds to an international exchange, where does CementDAO fit into that? Who do you need to onboard in order for that market to be matched successfully?
Right. So I'll give you 2 examples of the way we're being onboarded. So first example I'll give you is exchanges, which are still at the very heart of our crypto industry, right? Because most of the transactions have to do with trading or speculation. And so the exchanges, they have a problem. They're listing more and more stable coins. And it's becoming less and less manageable because each new stable coin that they add is something that they need to maintain. It reduces the user experience by increasing this complexity and making users have to figure out which stablecoin they're going to use. But the worst thing it does is it fragments their order books. So instead of having nice deep order books of USD to ETH or USD to BTC, they now have different types of USD, PAX to BTC and USDC to BTC and USDT to BTC. And so that order book, the BTC order book, becomes shallower, the liquidity becomes less, and the spreads become wider. And so a number of exchanges are working with us now to basically reintegrate the stablecoins under one ticker, which would be the dollar ticker or the euro ticker. And some really pioneering work was actually done by 2 Asian exchanges who attempted to do this themselves without sort of a broad protocol. One was Huobi and the other one was Gate. And the reason I think it started in Asia is because so much activity in stablecoins is being done out of Asia. And so, for example, what Huobi did is they created this ticker, HUSD. And you could send a whole bunch of different stablecoins to the exchange, but what you would actually see appearing under your user is your balance in HUSD, not in USDC or not in PAX. And so they basically created the dollar on their exchange. Mm-hmm. And so exchanges are doing the same thing, and our protocol, the Cement protocol, is helping them do that. Another example is a merchant, right? So
Huobi and Gate are 2 of the first customers or partners?
No. Huobi and Gate have created the system for themselves. Huobi have since had a lot of issues with it. It's very, very difficult to manage a protocol like this if it's not a protocol. So basically they were managing it as a book, and they took on all of that risk themselves, and there was no way for them to balance inflows and outflows, which is why interchange becomes important. It's a shared resource, a commons between different merchants and exchanges and people for using the stable coins. And so what they're doing now is they're launching their own stablecoin, which is likely to be part of the CementDAO mix. And so in that case, with an exchange, the exchange basically just integrates with our smart contract, and now they can start serving up deposit addresses to their users, which allow any user to send any one of the stablecoins that are in the Cement system to that address, and get auto-converted into whatever that exchange wants, or into a universal ticker, which we call MixUSD, but the exchange can call it whatever they want. Same thing happens with the merchant.
So who's the most important person or party to buy into this system as you work on these integrations? Is it the stablecoin issuer, or is it the end user that needs to do the work that Huobi and Gate had tried to do themselves by managing their own book?
Yeah. So the most important sort of type of user of the system is the receiver. Right, the type of user who says, look, I want to be able to receive a whole bunch of different stablecoins and consolidate them and manage them. And so that would be exchanges, that would be merchants or payments companies. And right now, a lot of our focus has been talking to exchanges.
Let's walk through how this is going to be decentralized, because you guys are doing the lion's share of the work right now. The name of the project is CementDAO. So I imagine that the goal is to disintermediate yourselves from some of this decision making. So first of all, where are you in the life cycle of this project? So what's the roadmap and kind of rollout plan for the 1.0 and beyond as you work towards actually creating a basket of stable coins versus maybe an incremental approach and taking one at a time?
So our system is currently live on Robstein testnet on Ethereum, and has also been launched on the testnet of Rootstock. And part of the goal there is to basically allow you to perform these types of transactions on any chain. And so we started with Ethereum and Rootstock. And we're in the process now of talking to and helping the first few partners integrate into the system. Now, the reason it's called a DAO is because ultimately we aren't going to make any decisions. So the system is going to launch decentralized when it launches on mainnet. And there's a token which is going to be used to help decentralize the system. It's a governance token. We call it the build token. And the build token is used to allow the community to choose which stablecoins are allowed in the system, what allocations they receive, to decide on any differential pricing or fees that need to be changed with regards to them, and most importantly, to remove from the system tokens which are no longer appropriate or potentially risky. And so what we're doing is we're working with those partners who are integrating with the system now, and we're going to be looking to allow their communities to have build token and to participate in the governance process. I think one of the coolest things that we're doing in terms of the governance process is there's a lot of DAOs out there. It's an extremely interesting space. I think one of the most interesting things that is happening in the blockchain space is this idea of creating communities that can govern themselves in a non-hierarchical way. But what we're doing is we're working to try and build a system which is extremely robust against various types of attacks, and which is going to be able to make extremely good decisions. Because you need to be able to make very good decisions about which tokens you allow into this type of system. And so our system is not built on simple staking or voting. It has the system is driven by futarchy, which is a new something that we and a few other projects are working on. I think is going to be introduced over the course of the next year into a number of DAOs. And the idea is that you allow prediction markets to become decision markets. In other words, prediction markets can predict the best outcome for a DAO. And if you construct the system where the prediction market sits at its core, whatever the prediction market predicts is going to be the best outcome, the system will automatically choose. So it becomes a very market-driven process where people can participate in predicting which stablecoins are going to be the most stable, for example. And whichever ones they predict are the most stable, the system will automatically adopt. So there's actually no human being doing the adoption. It's the system itself, the smart contract itself.
And when do you anticipate this is going to go live on mainnet?
So I don't want to give out a date. We are basically ready. The thing is, we want to make sure that when we launch it, it launches decentralized. And so a lot of the work that we're doing now is trying to make sure that we can disenfranchise ourselves and have other partners and parties involved in the project from day one. And when that's ready, then we'll launch.
Can you walk through the process or kind of the different stakeholders in the system and how they're rewarded? So basically, the maintainers or primary governors of the system are going to be absorbing the risk associated with any instability in the underlying components, right? And essentially earning the rewards and fees that would come from the deposits that are components of the CementDAO currency. How many of those stakeholders do you need around the table to get comfortable with launching on the one hand, and then how big is that pool of funding? Because if you are a stablecoin issuer, there are a number of things that you can do to entice people to use your stablecoin and actually deposit funds with you, because you know that you're going to be able, you could offer a discount, for instance, because you know that you're going to be able to reinvest the underlying and generate some type of yield on it, even though the interest rates are obscenely low right now. But with you guys, that's kind of abstracted away, it seems, to a certain extent, because you're a stablecoin, a basket of stablecoins. So the issuers are still the ones that are collecting the underlying dollar or euro or yen collateral, no?
Yes. So there's a number of questions there. I'll try and answer them. So first of all, right now, most of the stable coins, and certainly the most popular ones, are backed by reserves of the same currency in a bank account somewhere. And so one of the nice things of our system is it allows multiple different...
Or at least we think so, because there's no audits of any of the issuers just yet.
Yes, well, they're backed by a claim on. So actually, look, a number of the issuers have been providing audits, but I don't think that really matters, right? The crux of the matter is that there's a central party which is responsible for guaranteeing that issuing, creating, and also managing those tokens. And so one of the nice things of our system is it allows you to have multiple different issuers like this within the system. It creates this basket, as you call it. We call it the mix. And users can also hold abstracted tokens, so they can take a centralized token, deposit into the system, and get out a abstracted USD token, which is more decentralized. Now, how do you deal with the risk? Because a user who's holding a token like that, if one of the underlying tokens now loses value because it collapses, because their accounts are seized by the New York District Attorney, how do you deal with that? So the way we deal with that is twofold. First, there's the ability to be a risk holder in the system. We actually have tokens which we call the risk tokens, and you can deposit stablecoins into the system and get back risk tokens. These risk tokens earn a yield, but in return, you take on the risk from someone else, right? Somebody who doesn't want to hold any risk, that one of the issuers might collapse or might lose value. Usually they don't go down to zero, they lose, a haircut. 10%, 20%. So that end up with 80 cents on the dollar that they put in. That's the potential risk that they're taking. If that fails, then the build token holders, who are kind of like the last resort in the system, in the same way that the Maker DAO system can create new Maker tokens and use them to recapitalize the system. In our system, if the risk token doesn't absorb enough of the risk, then the build token holders are diluted in order to recapitalize the system. Now, you asked about who the different stakeholders. So the stakeholders who are involved in governance are the build token holders. And the build token holders can be involved in governance in two ways. The first is they can stake with curation agents. And the curation agents, their goal is to whitelist which stablecoins are allowed into the system. And if they do a good job, they get rewarded by the system. And so they're sort of the first line of defense. But they actually, even if a token gets whitelisted, it's actually not in the system, because the next step is the future system or the prediction markets. And there, what the system is actually doing is it's using the fact that build can be used for a proxy of the value of the system, because it all of the fees that are collected by the system are used to buy and burn build. Basically, what the prediction market is doing on an ongoing basis is it's saying, all right, let's say we introduce change into the system. That would create one of two scenarios, right? The change is accepted or the change is not accepted. Mm-hmm. Which of these two scenarios is predicted to have the highest price of the dollar, right? The dollar stablecoin to the build. In other words, which one will create the higher price for the build? And whichever change, or maybe the status quo, is expected to create the higher price for the build is automatically what the system adopts. And so the primary way in which you can actively participate in the governance is by sort of betting in these markets with the build tokens.
Got it. Interesting. Well, the one thing that always comes to mind with the stablecoin markets is just how much money the issuers can actually make, right? So it seems like there's a ton of default risk, there's seizure risk, there's regulatory risk when you think about things like Tether. There are usability risks when you think about some of the more heavily regulated digital dollars, right? USDC and Gemini dollar come to mind, Paxos as well. And then on top of that, interest rates are low, and then to top it all off, you're talking about creating a system that bridges all of these together. It just doesn't seem like the market is that large or that liquid just yet, and there's much more downside than upside when it comes to earning fees. What do you think some of the catalysts are that would make this basket-based approach to managing stablecoins more economically interesting for people that wanted to get involved in CementDAO as a curator, for instance? Because it seems like right now, if you're going to look to provide similar services, you can make a hell of a lot more money if you are providing like staking as a service, or you're participating in any of the active governance or curation of some of these systems that have much larger yields embedded in their programmatic inflation of the underlying asset. And those aren't stable assets, but it doesn't matter. If you're the curator, you can see quite a bit of cash flow from that. What has to change for this to become more compelling, market-wide and internationally?
Right. So I think that there's actually, even now, stablecoins are extremely compelling for a number of reasons. The amount of money that you can end up making from a stablecoin is very, very substantial. So the different stablecoins have different ways of generating yield for sort of their communities or their owners, right? If you are Tether, you're sitting on $4 billion, which is, just passively sitting in an account generating some yield for you, probably around 2.5%. So 2.5% of $4 billion is actually quite a lot of money. Given that you're actually not involved in doing that much, and there are also strategic benefits, right? So all of the other exchanges that use USDC are effectively banked by their competitor Coinbase. So Coinbase becomes the bank to a whole set of exchanges, which effectively introduces them into their ecosystem. Now that's sort of like on the issuer side. In terms of the actual activity that is happening in stablecoins, the most traded coin on any given day is sometimes Bitcoin and sometimes it's Tether in terms of the volume of trade that is happening. And the stablecoin space is the fastest growing space right now in the cryptocurrency space. So projects, for example, like Maker, the MKR token, which is not DAI, is worth, depending on the day, somewhere, has a market cap of between $500 million and $700 million. And I think the reason for that is that people believe that stablecoins are going to be one of, if not the biggest part in terms of the trade, payment, and store of value activity that the vast majority of users have. And certainly the excitement around Libra tends to show that. And then if you look at DeFi is totally driven by stablecoins. So Compound, Maker, DYDX, they all have most activity and the most interest earned on these various stablecoins. So I suspect that both from the ability to drive yield through the risk tokens and the even small interchange fees that will be driven by a large number of transactions in the stablecoin space, Cement will actually end up being a very interesting focus of activity. And there will be a large number of parties who are there either for strategic reasons and want to participate either for strategic reasons or simply because they're interested in DeFi, they're interested in finding new and interesting ways of driving yield, especially in a way which is predictable, which you can sort of do a discount cash flow analysis, which is usually not possible to do with most staking tokens. And so it's a new way of being able to participate in crypto, and especially to be able to take a view on stablecoins. Right? There's no way you can invest in USDT. There's no way you can invest in USDC. But by being involved in the Cement system, you can effectively take a view on the entire stablecoin space as a whole.
Well, time will tell, but certainly be on the lookout for the mainnet launch and some of the other key milestones on the roadmap. Edan, this is I'd say a boring but important part of market infrastructure for crypto. Maybe not your project, but stablecoins in general. The prices don't go up and down. At least, hopefully, they don't. But certainly there's still quite a bit of work to do to connect all the plumbing, even for this boring type of asset. So appreciate you shedding a little bit more light on it and taking the time today. We'll do it again soon.
Thank you for tolerating the more boring side of crypto, Ryan.
You know what? I said boring but important, so important caveat. All right, everybody. Until next time, thank you for joining. We'll see you again real soon. Peace.
Cheers.